Okay, so Ric, thanks for joining us for the quarterly update. So how's all things in the world of Adansonia?
Hi, Rob. Yeah, thank you. Thanks for having me. Look, as you say, things are going well. Look, we in the last monthly update, we sort of touched on that the portfolio has had a challenging couple of quarters from about March, April, where essentially the market's largely been driven by a couple of large mega cap companies that are driving or running on very strong momentum with respect to the AI theme, which we don't own. And simply on valuation grounds. And these are namely Tesla and Nvidia, which are the first and second largest stocks in the index we measure our performance against. And then Tesla and Broadcom. I think the Broadcom's the 10th. So the problem you've got is that when you've got the first and second largest stocks in the index, basically outperforming the index by a factor of 4 or 5 times over a couple of quarters, and you don't own them, it's mathematically very hard to keep up. But we're starting to see a little bit of a normalization in that. I'll be doing a separate call on the portfolio performance, but just very simply for September, we returned a positive return of 20 bips versus the market down 30. So a small turnaround there. 3 months, as I said, has still been difficult. We're down 0.6 versus the market up 2.8. But as I said, we're starting to see a bit of a normalization, and also reporting season has had a little bit of a reality check on some of these stocks. And longer term, since inception, which is about 5.5 years, our performance is still intact. We're 15.4% per annum versus the market 14.3. But as I said, JP Morgan, which was the first stock in our portfolio, one of the big banks that had a great result, outperformed strongly versus expectations. Taiwan Semiconductors had a great result. LVMH, which has been a bit of a laggard for us. Again, revenue came in a little bit lighter, but the market's now finally started to see that it's all in the price. The stock hasn't been basically smoked as it was a couple of quarters ago. It's actually rallied from its lows after China started to stimulate. And the nice thing for us is that Tesla, which is one of the stocks that we don't own, which has basically performed very strongly of late, basically showed that they have very little meat behind their robotaxi strategy, and that stock sold off over 10%. And importantly for us, for Uber, which we do own, it rallied 10%. So we're hoping that we'll have a pretty solid October, and things will start to normalize after a couple of challenging quarters for the portfolio.
So in saying that, Ric, that's all short-term stuff, right?
Oh
So
yeah. Look, it is, and I mean, look, we're not happy to deliver the news that we've delivered over the last couple of months, but in the end, the only thing I can say, Rob, is that we're staying true to our approach, true to our process, and we won't buy
no.
extensive stocks that are running on momentum, and it'd be very, very hard for us to explain why we're going to, spend $15 on something that's worth $10 to then, see it lose money. I mean, so as I said, we've missed out a little bit, but longer term, we're very comfortable with our approach, and we've proven it in the past. And at the moment, we're also a little bit cautious on the outlook for the market. The market is trading, or the S&P 500 is trading on a 25 multiple of 2025 PER of over 21 times. It's not cheap. Portfolio is currently running with about 9% cash, 13 stocks, and realistically, if we see the market continue to melt up the way it has been, we'll be increasing our cash. As I said, we're just finding it difficult to find value in this market at the moment.
So let's just talk about valuation there for a bit, because I think it's important. Probably one of the easiest ways to lose money over the longer term is buy expensive assets. It doesn't matter how good they are. If they're too expensive, they're a bad investment. Yeah.
Well, that's exactly right. I mean, look, in the end, fundamentals do win out. So the market can stay irrational for a little while, but in the end, fundamentals do win out. And look, case in point, I mean, look, Nvidia is a great share. I mean, but it's trading, at 36, 37 times multiple, versus like Taiwan Semiconductors, which is our sort of proxy exposure, because it creates Taiwan. And again, I'll be talking about this in the quarterly for September. But Taiwan Semiconductors basically creates or makes all the shares. Sorry, makes all the chips, computer chips for Nvidia, and that's trading at 22 times, 25 multiple. So I mean, it's and we own that, and the stock's done very well and had a great result. So as I said, it's hard, and especially with what we're seeing now is that we needed bond yields to basically to come off meaningfully, to I guess reduce the cost of equity for the market and justify some of these multiples. And now, I guess with respect to the outlook for a Trump win and a shallower, I guess a shallower easing cycle in interest rates because he's going to have basically looser fiscal policy. We've seen that bond yields are now back, or 10-year bond yields are back up now to 4.5%. So the curve's steepened, the curve's moved up, and also the dollar has strengthened on the back of it. So these are all headwinds for the market. So as I said, there's just been a lot of volatility at the moment, and we're just a little bit cautious on the outlook given what's currently priced.
Yeah, and that's the discipline, and that's the discipline that that's why we get you guys involved, because you got to have that discipline. Just talking about valuation, I always like to sort of talk about Cisco back in the tech boom, and then ultimately the tech wreck. Great business, still is, but basically during the tech wreck, the years that followed, it went on to lose about 90% of its value.
Yep.
And that was purely a function of the valuation that was baked in on the way up was unrealistic.
Oh yeah, well, I mean, look, as I said, and I mean, people started to basically, price those stocks on revenue multiples as opposed to earning multiples, and then
they come up with reasons to buy
and then potential price to earnings. As you say, it was really the analysts were chasing share prices and trying to justify share prices for the music stock.
Yeah.
So as I said, and look, realistically, Rob, as you know, with the fundamental approach, the way you make money over the longer term is to take the market on, and be a bit contrarian, but in saying that, sometimes it can hurt a little while. It can hurt.
Yeah, absolutely.
So, as I said, look, we're comfortable with the outlook. As I said, our long-term performance is in place. As I said, we've got an objective to outperform, over a rolling 5-year period, which we still are. Unfortunately, though, we've given back some of that alpha, but we're hoping to sort of reestablish that. We're hoping to reestablish the near-term performance, from this point forward. And as I said, September was an okay month. October is looking okay, and hopefully, we'll sort of see a normalization with some of these stocks. And also, what we sort of saw at the end of the quarter is that winners over the first couple of months sort of became laggards to a degree, and you saw some of the laggards basically start to perform. So there's been a bit of a broadening of the performance base. So as I said, there's a lot going on.
Yeah.
There's a lot.
So speaking of things going on, obviously we've got two sort of conflicts happening around the globe at the moment, and obviously the US is in the middle of that as well, as it always is. What sort of credence do you sort of pay to events such as that in your analysis and deciding whether or not to invest or not invest?
With respect to geopolitical issues?
Yeah.
Yeah. Well, look,
Yeah.
I mean, obviously we try and, well, I mean, in a broader scheme, we avoid political hotspots if we can. So obviously we own no stocks in Russia, and stuff like that in the portfolio. I guess with respect to the existing conflicts that as we're seeing them, it's like it's the frog in the boiling pot analysis, in the sense that when you get war breaking out like we've sort of seen obviously with Ukraine, the market basically reacted very strongly, basically sold off. We saw oil prices spike, but it's, I think, what we sort of seen to a degree with respect to, like, Ukraine and Russia, China, Taiwan, is that the market's learnt to live with it to a degree. So not that I'm saying it's not important, but it's the market basically just, I guess, absorbs it and moves on. Unless obviously there's a meaningful sort of change from the norm where it might shake things a little bit. But look, we essentially are conscious of it. We try and avoid exposure to those areas. So I guess at the time, um, when you had the Russian conflict, I think, essentially the largest exposure we had to that stock was in Volkswagen, where a lot of the parts for some of the models were basically disrupted, or the supply of the parts to some of the Volkswagen's models were impacted by supply chains that were choked off. But look, we sort of understand the geographical exposure of the revenues and the earnings. We try and avoid them where we can, and in saying that, if the conflicts which have been ongoing for a while, the market has learned to live with them and move forward.
Yeah.
So
Okay.
yeah. So
All right. So, I mean, the story at this present point is, yeah, markets are hot. We're sticking to our disciplines. We're not getting exposed to something that we're uncomfortable getting exposed to,
yep.
because we know that we'll get caught out over the long term, and we're just plugging along doing what we need to do.
Yeah, yeah. As I said, look, I mean, it's very much a pickers market. As I said, the market generally over the last couple of quarters has been driven by a very, very narrow range of mega cap stocks that are AI related. But if you have a look at the market basically on an equal weighted basis, it's trading at a multiple that's a lot lower than the 21.3 times, because obviously that multiple is being supported by a couple of large, very expensive stocks in the index. In saying that, it's there's not a lot of value that's sort of pervasive. As I said, the number of stocks that I've looked at, which of late, which are trading on multiples in the 30s, and are still being sort of supported by analyst recommendations, is staggering. In saying that, these are great stocks with very, very strong growth outlooks, but there's a lot that can basically trip up some of these outlooks, with respect to what we're seeing at the moment. With respect to a Trump win, does it basically start another trade war? Will it spike shipping costs? Again, I mean, dollars going up, currencies going up. I mean, there's a lot of headwind there, potential headwind or disruption to global economies, which can drop growth rates. Off top of that, obviously, as I mentioned, 10-year yields has backed up as well. So the cost of equity in the market is not as low as what it was, or what the market was previously expecting. So there's a lot to
And
sort of
that's
digest.
the thing. That's the thing about high valuations, right?
Mm.
There's no give.
Well,
Right?
exactly, and high PE stocks,
Yep.
if the market stops, they come back
Yep.
hard,
Yeah,
as we've seen.
exactly. So, okay, excellent. All right, Rick. Well, look, mate, thanks for the update, and keep up the good work, and we'll look forward to catching up with you next quarter.
Yeah, not a problem, Rob. My pleasure as always, and also thank you to the people that have supported us and invested with us. As I said, I'll be doing a separate monthly, sort of going through the portfolio in a little bit more detail. But our pleasure as always, and thank you again for the support for the product. Much
No
appreciated.
dramas. Good on you, Rick.
Thanks very much, Rob. Have a good day.
You too, mate.